Right. So let's look at some special rules and some special instances, um, and see how this works. So what do we have here? We're still talking about chargeable gains. Again, as you can imagine, relationships, especially when we have, of course, husband and wife, civil partnerships, as long as they're living together, you would expect that they can transfer assets between each other at nil gain and nil loss. Right, that's the first key thing there. So that's at nil gain, nil loss. We're not really interested until, think of them like in like a little group, until the asset is actually transferred out of the group or the party. Then we may start to realize a chargeable gain. So that's the first thing. Um, this is we're dealing now with individual, and we're talking about couples, so we're talking about individuals, right? So there is no indexation. Like the indexation you saw us do when we did company was to do with was when we were dealing with company, when we looked at computation of corporation tax. We're looking at the company, but with individuals we don't have this issue. They have an annual allowance, annual exemption allowance. Okay, great. So let us carry on. So let's look at this scenario here. We have Sandra. She bought some land on the 1st of August for 100,000. She gave it to her husband when it was worth 125. This number is totally irrelevant. She gives it to her husband. She gifts it to her husband on this date. There is no indexation for inflation. She literally gives it to him, and it is at that cost of 100,000. He goes along and he sells it for 130,000, which is fine. So what we now have is this minus this gives us a 30,000 pound gain. And of course, he can take away his own annual exemption allowance from this, and then whatever is left is taxable. And that's kind of the key point. It's transferred at nil gain, nil loss. So the cost remains the same at 100,000. And to whom? It is, of course, to the husband. He has to pay. So again, like I say, the key point is, in terms of tax planning, you want to be thinking, could I have sold half of it and used some of my annual exemption, if you like, because once you do it like this, like what we just did, your husband, you're only really utilizing your husband's AEA. Your AEA is wasted basically because you didn't sell anything regarding this land. I mean, you might have had other assets. We don't quite know the full picture, but if that was the case, it's something to think about. So again, the whole point is look for ways to utilize both band rates, any unrelieved capital losses, and annual exemption allowances. Those are your tools available. Now, this part disposal thing, I talked about it in class, and it's important because it is based. I talked about it in class. It is based on. It is based on value. Really important, this trying to understand. Typically, when we sell part of an asset, we want to ascertain what the gain is on that part that we have sold. So we must know what the cost is of that part that we have sold. So just to kind of illustrate here, when we have a picture, imagine you have a picture here, or a piece of land, forgive me, it is easy to think that, okay, because this is 3 hectares or whatever, and this is 11 hectares, I'll make this 12 hectares, that somehow the value of the land is split by virtue of size. Well, no, because we don't know what's on the land. Maybe this is all dry, parched land, and this is where all the good vegetation sits. So I think it's something to think about. It must be therefore based on value. So, and then because it's based on value, because we deal with the proportion in terms of the cost proportion based on value, then we can then deal with whatever the gain is. Let's see where we're going here. So, I just want to highlight a few points. This is just in the way, but the theory is the same. Incidental costs. So you have to try to deal with the incidental costs based on how they're treated. You can see if they relate solely to the part, deduct in full from the part that's been sold, of course, because that's just to do with that. But you'll see what I mean. If it relates to the whole asset, apportion in the same way. So let's see what we have here. Here we have Here we have this scenario where we have Alice, certain Alice. She buys 15 acres of land. So there's 15 acres here, and it cost 21,000, and the incidental costs were 600. I'm just going to keep it separate. And then what she does is, in June 2008, she sells off 4 acres. So that's 4 acres there, and that's 11 acres there. So the question here is, I'm told that she sells off 4 acres for 22,500. So if I'm to know what the gain is, I mean, and it says here that the market value of the rest of the land is 45,000. So this bit, the market value here is 45,000. Okay, so this is the sale. These are the proceeds from the sale. I'm just going to call this A and B. I mean, I want to do proceeds minus cost, right? I have the proceeds, 22,500. The question is, what is the cost of this piece of land? Intuitively, you might, like I said earlier, you want to say 4 divided by 15 times 21,000, and then or times 21,600. But we don't use acres. We use the value because, like I say, we don't know what's on the land. And land is really about value. So therefore, the cost of this land is therefore 22,500 divided by, as a ratio of 22,500, of course, plus 45,000, this whole thing, times, if you like, I'm just going to change my pen color, times 21,000. I'll do exactly the same thing because I'm trying to get 22,500 plus 45,000 times 600. I'm trying to get what the cost is of A and the incidental costs of A. So the costs of A are this thing times this, and so when we do that, and that is, if you like, that's 22,500 divided by 22,500 plus 45,000 times 21,000, and that's 7,000. So the cost of A is 7,000, and this came to a third. This is a third. So a third of this as well. So the incidental cost of A as well technically would be considered to be 200, and therefore the cost of B is 14,000, right? Because this makes it 21,000, and the incidental cost, of course, will be 400, and that makes it 600. So now I have the cost of, and I can apply that cost here. Now I can find out what the gain is because I have the cost. Incidental, just to the selling of this bit of land, we had to pay, they tell us, you had to pay disposable incidental cost of 2,500. So you deduct the 2,500 from here, which gives you 20,000, and then you now have to take off this 7,200 to get the gain. So 7,000. So 20,000 minus 7,200 gives you an overall gain of 12,800. So that's the gain on the selling of this piece of land here. Over here, we now have here that the base cost, in effect, when we come to sell this piece of land, we have a base cost ready, and the base cost, forgive me, is the 14,000 plus 400. I haven't sold it yet. I mean, if I was selling it the very next day, it probably will be 45,000 less any incidental costs to sell it, and then less that. Great, cool, great. So that's that. I don't know how long that video has been, but let me go ahead and just I can't find it disappears. Let me just go ahead and just discuss very briefly this idea of actually, let me just see how much. Maybe I might need to take a break, but let me just see so that you can look at this in context. Right, yes, so what I'll do is, I think what we'll do is we'll take a break just because they're different chapters, and we'll stop there, and then we'll just come to the next part and just do the next video looking at chattel so we can discuss it separately. Cool, great stuff. See you in the next video.